Okay, so making a new video here. What we're going to do today is we're going to talk about how to create or how to find a good entry signal. Like where to look for the entry signal, the context of the entry signal, and what kind of entry signals you could use. I personally think when we talk about this, there's a lot of different entry signals. Many. A lot of different techniques, a lot of different little ways we can look at this thing. I think what's more important than the actual signal is the context of the signal, within the context of the trend. The real, in my opinion, the real signal is the trend. Now, where to join it in the right place means understanding the trend, understanding how trends develop, finding the correct context and place to join it. And then you can use one of many entry signals. I'm going to use a couple examples today, but I think that is the main lesson, is the context of where you're trying to find your entry. All right, so let's start off. The main thing I'm looking for is trend. I'm actually going to look for a lower time frame signal here, but I'm going to start actually kind of analyzing this as a possible entry, or where the entry should be. Looking at a little higher time frame. So you can see here I'm looking at the daily chart, and I'm looking at the Qs. Now I'm looking at the Qs because something's changed here in the Qs. If I look at a rising trend line off of the lows from the beginning of this year, we can see, depending on how we draw it, you might draw it a little more like that, but joining these 2 points here, probably best fit. We definitely broke the trend line. All right, so we have a broken trend line. So that's now got me thinking, all right, broke the trend line, it's bearish. That's a bearish development. We also broke, if we look at this trend, we broke the control swing low, which is a break in the trend structure, because when we're following the trend, what we're looking for is this: an impulse, corrective, impulse, corrective, impulse sequence, right? Impulses and corrections, alternating. Now, this is the general structure you see right here of this move up in the NASDAQ from this low to this high. Let me overlay that again. You can see it. This is the impulse. Here, let me actually write that. There's an impulse, and there's a correction. Okay, so impulse, correction, impulse, correction, impulse. Now, when we have the structure, that would make this point right here from the last correction, the low from the last correction, that makes that what's called a control swing low. So I've gone over all this in our trending, how to find trend video, but it's worth reviewing. All right, there's our control swing low. All right, now, just to be very clear, let me highlight it. Right there. Okay. So that point on this chart is right here. And that's on the Qs, that's 357. 357.64. Now we can see, if we zoom in a little bit, we can see that we broke it. Actually caught a bounce from that level, broke it again, and really convincingly broke it just recently. We're really clearly through that area. So now what that means is this whole upward structure right here that was forming is now suspect. So I'm going to get rid of that. And we're thinking about now how to take advantage of the new bearish action that's developed. Okay, so we're looking now in this direction because the control swing low has been broken. All right, now we're gonna actually go down a time frame. Look at this trend in a little different time frame. Now, typically when I do anything with stocks, if I go down to an hourly time frame, I use 65 minutes. The reason is it's 6.5 hours in a day. 65 fits in the data actually fits better, and you can see the chunks from day to day. So here's our trend if we look at the hourly. Now there's that control swing low that we saw in the daily. That's all the way back here. So you can see that we broke this pretty convincingly. And I'm going to get rid of all those drawings. And now we're really dealing with this downtrend action. And it's a very well structured downtrend. You can clearly see the impulses and corrections. So if you can't, I'm going to go from the swing high, the highest point in the chart. Swing low, whoops, wrong tool. Swing low, swing high, swing low, swing high, swing low. And since that high that was made in this summer, in July, you can see this is the structure of the price action from that point. Now, impulse correction, again, impulse correction, this is a correction, impulse. So it's a downtrend. The action's going in this direction, and we clearly see really well-defined structure in the chart. Well, the expectations then would be that what happens next, looking into the future, is that we see a correction form followed by a impulse, right, making a new low. All right, so when we talked about this last video, the name of the game here is figuring out where this turn is going to happen. Let me change the color of this. This is looking for, I'll make it green. The green part is the part that hasn't happened yet. That's looking into the future. So our anticipation is that we will see two things. That we'll see a corrective action against the primary trend, and that we'll see an impulse to the downside. The impulsion move will be down, extending the trend. Now, does it have to happen that way? Absolutely not. But we're just talking about probabilities. The probabilities at this point, at least, would favor that that is what happens. So for us, to figure out where to get in with a really good entry is about context. What we're trying to figure out is where this turn happens, where it transitions from being a corrective move against a trend to a new impulsion move. And we're trying to jump on the train before that impulsive move takes off to the downside. So we're trying to find the bounce, figure out where that bounce is going to stop, and then resume the downward action. All right, so this gray area right here, that's the spot that we're looking for. All right, so how does that translate to the chart that we're actually looking at? Well, let me get rid of this. All right, oops, move this around. All right, get rid of that. All right, so here's that chart action. Let me overlay it again. And that means that we're looking in this, on this impulse move right here. This is the spot. And the action against it should look something like this and then like that. All right, so and we're trying to find out where this is gonna turn. All right, so if we're anticipating this, we're gonna use a couple different techniques here. One technique that we use a lot, that I use a lot, is looking for supply and demand zones. So that's one thing that we'll do. I also use a lot of anchored VWAP to help me kind of zoom in on this, where in this area this turn is going to happen. And I also use something called volume profile. In this case, we're going to use a fixed volume profile. Now, these tools, and it doesn't have to be this way. What's important here is you don't have to use these tools. What's important here, though, is, and I think that you do have to use, is you're going to have a lot more success and much better probabilities going with the trend. You get a little more advanced. You're going to learn how to go against trend, or when trend gets extended in each way. That's another lesson. But look, a lot of what you're going to do is going with the trend. And the reason you want to do that is because you want to capture these impulsive moves. The impulsive moves are where all the energy are, and it's where all the real money's made. So capturing impulses is typically more profitable, a lot more profitable than trying to catch counter trend moves. Trend reversals, where it's transitions, is a whole different story. Where again, you're trying to capture new impulsive energy going in a different direction, and that's for another lesson. Okay, so I'm going to use 3 tools. I'm going to use, here, let me write this on here. Supply and demand zones. Let me actually write that out. That's a pretty well-known concept for finding transition areas. I think very effective, really good way to find entries and to control risk and define risk, or supply and demand zones. So if you're not familiar, if you're watching this video, you probably are familiar, but if you're not familiar with supply and demand zones, it's something worth looking into. We're also going to use anchored VWAP. Now, VWAP stands for volume weighted average price. So we're anchoring from a point and finding the volume weighted average price. This is typically where most of the volume has traded in from wherever you're anchoring the measuring tool from. And we're also going to use a fixed volume profile. All right, so here's 3 tools that can help us. Now, typically when you're looking for a supply-demand zone, what we're looking for is, the way I always describe it, is looking for like motion, a halt in motion with a lateral movement, and then motion again. You really want to see where, here, and I'll show you a zone. Then I want this to be totally a zoning lesson. All right, so we might do something like this. There's a lot of different techniques. Some guys will try to isolate like the last bullish bar and use that as a zone. Some guys will, and this is really what I do. I'm really just looking, in this case, looking for where there's motion, halt in motion, and a continuation of motion. Let me show you what that looks like. Something that would look like this. Right, where it comes down, stops, drops again, would be a classic kind of zone. It's called a drop-based drop, right? So it looks, when you look at, if you took all the wiggles out of it, down, sideways, down. This is a bearish version of this. Reverse it for a bullish version. Okay, so if we look in the chart, we can see a couple areas. There's an area in here where it moved, it paused, and it dropped. An area right here where it came down, paused, and dropped. Now, again, guys try to be a little more, really kind of dial it in. I don't. I tend to play a little more fast and like that. I won't say fast and loose. I say I'm just trying to get the nature of it, where it came down. In this case, because it's dropped, came down, went sideways, and then continued to the downside, making a new low. Now, the key thing here is that for a good zone, is that you made a new low. There's the prior, what's called the prior swing low, right? It's the prior lowest point. And by breaking that, you eliminated the trend. Like if you look here, before, even if you had a zone above that, before that point, you never changed the trend. The trend wasn't reestablished, or it didn't have energy on the downside. After you break it, it's fairly obvious, or break this low point, what's happening. So it's not going sideways, it's going down. So you really want to look for a zoning area where you have that sort of breakout. That's one thing. Now, you may have several zoning areas. Like if you even look at this chart right here, there's a smaller one down here. These are supply zones, and these are really kind of the only two I would pick. Nothing else is broken below that low. Okay, so there's one way. So now I got two. So which one do I go with? What do I do? And you may have a more extended, impulse move down, and there could be several. There could be several really good looking ones too. I mean, it's just depends on what you're looking at. So that's where we, how do we pick the right one? Okay, so here's a couple tricks to help you. I'm going to use an anchored VWAP. Now, the important thing about the anchored VWAP is where do you anchor it from, right? You can't just pick any random bar and anchor it. What you want to do, again, in the context of the trend, is anchor it from the last swing high, so the beginning of the impulsive move down. All right, let me take this box off. And you can see here, I anchored it right from the peak right there. And what it tells me is that this price right here, which is right now at 357.98, most of the volume that's happened here is the average price that's transacted during the move from this point to here is 357.98, or what is it exactly? 357.84. Okay, and you can see that coincides with my zone up here. So that's giving me a clue right there. This might be a little low. Now you can already see this zone right here. It came down, halted, and dropped again to a new low. Came back. It actually got hit. Got hit today, and backed away from that. Okay, so this one's already been hit, already been used up mostly, and frankly, it could go lower right now, but I suspect that what we'll probably see is more upside in a kind of relief rally off of these lows that we just had. We got very overextended, the subject for a different time, very oversold, and they set you up for a counter trend move. All right, so we got a zone up here. We got a VWAP that's corresponding with the zone, and now I'm going to use the fixed volume profile tool. Now, volume profile is showing me something similar to anchored VWAP. What it's showing me is where most of the volume has traded. And I say fixed volume profile because I don't want to use a whole volume profile that looks at a bigger time frame. Like usually volume profiles look at where the volume has traded, and maybe pull up on a daily chart and it will show in the whole chart area. I want to be very specific about where I see the volume trading. And I'm looking just along this impulsive move. Again, same thing. So I'm going to grab something called a fixed volume profile, and it'll allow me, and TradingView has it, I think NinjaTrader has it, and you may be able to customize some tools to get it if you don't have it. But this is going to tell me where the volume traded in a piece of price action that I define. All right, so I'm going to start at the highest point in the swing high here for this move. And I'm going to go to the swing low. Okay, now, let's see. Okay. Now this one's showing that most of the volume, and with that red line right there, that's what's called the point of control, POC, point of control. And that's where the volume peak is. Well, what you can see here when you look at this volume profile is that most of the volume that traded in this move traded at the top of the move as it transitioned over. Okay, and that gave us a POC right here at about 365.25. And it's certainly, you could certainly see a rally that could take it that high. I don't tend to think that's going to happen. I'm usually looking in a situation like this about halfway down. About a 50% retracement, if you want to talk about Fibonacci's. If you look about halfway down at the 357, you can see there's another peak right here. It's not as high as this one, but there's another surge in volume that happened right there. So I've got a bulge in volume at the top and a bulge in volume in the middle. Now, I'm going to show you from right here. You can probably see it. Okay, now that line right there is, let me make it green so you differentiate it. All right. That coincides with my zone. So I've got kind of, I've got an increase in volume. I got the anchored VWAP, which tells me the average price for most of the volume traded is right in this area, and I've got a zone right in this area. So that's a lot. I got a couple things that suggest that this rally is going to come to about here, this counter trend move, and drop. Now, could this be a lot weaker? Could this be more of a mess? Yeah. And I would have to reevaluate at that point. So remember, this is just about probabilities and what you're trying to do. But there may be, if this thing keeps rallying, the bearish structure is still intact, and this may be a good area to really kind of be looking for shorts. I always call that like an area of interest, right? An area of interest is right up here in this 355, 357 area, somewhere right in there. Now, if I look at the zone, and this is really what I'm seeing when I look at the zone. All right, let me pull this over. That's my zone. In this area right here, you see how I did that? There's the impulsive move in. Here's the corrective move, and then there's the move out that takes it to a new low below the swing low. All right, and that's what it looks like. And the zone area, or the supply zone in this case. Now remember, I'm using a supply zone as an entry because the trend's going down. The supply zone is, if I can find it, just looking for drawing tools. It's this area right here. It's this area where it pushed back, where there was a pause. That corresponds to this area right here. That's a little messy, and I kind of drew this where it encompassed everything as the halt, like that whole area. You can certainly tighten this up or widen it up as you see fit, in my opinion. What's going to change here, I'm going to get rid of this lower one. What's going to change is the risk that you take, right? Or what you need in reward. If you use a bigger zone, you got a better chance of getting into the trade. Your position size is going to be smaller, which means, because the risk you want to take is probably from the entry to the stop loss, which the entry would be at the beginning of the zone, stop loss would be like just above the zone. That'd be a typical risk scenario. If you make it smaller, your reward doesn't have to be as big, meaning it doesn't have to go as far down to get a meaningful risk-reward ratio return. I'm usually looking for at least 5 to 1. I usually look for a lot more. If you make it bigger, it's gonna have to go further to get that sort of reward. That's a call. That's a call you got to make as a trader. It just is. All right, so you got to figure that one out. We'll talk about sizing, the mechanics of sizing and risk-reward ratios and all that kind of stuff later. All right, so there's an example of how to use this, what you're trying to do, how to use a couple of these tools, and really understanding the important part, which is the context in which your entry zone is in. It can't just be anywhere. It's got to be in the right place, because what you're really doing here is you're trading with trend. So you're trying to use the trend direction in combination with trend structure, how trends form, which is impulses and corrections and impulses. All right, let's do another one. Let's do another example. And let's go through it a little quicker. All right, you can see I got some stuff on there, so let's get it off. All right, so this is Albemarle, lithium producer, chemical company in the U.S. Okay, so when I look at this, I see a really well-structured downtrend, right? And by the way, guys, I'm only using downtrends right now because it's October, market's in a bad spot. All right, so market's weak right at the moment. All right, so if I look at this, what I see is 1, 2, 3, 1, 2, 3. Really well structured impulses and corrections. All right, so this is the trend as I see it. All right, now that means the piece that I'm actually really interested in is this piece right here. All right, that's the context I want to find my short trade in. Okay, so I'm gonna remove that. And let's just draw this last piece. 1, 2, 3. And I really want to zoom in on that box, this area right here. Okay. Now, when I go down to the lower time frame, oops, let's use 65. We're dealing with the stock here. Okay. So we get the proper context. So right off the bat, where I'm looking is I see some zoning area right here. Some stuff right there, some stuff right there. I see a nice one about halfway up, which is something that I'd be interested in. So I see a couple. This is a good example of seeing multiple areas that look really interesting, especially since we just broke out to the downside right here. Now, this is tied to EVs. Tesla was weak today, so I think this is dragging this stock down with it. It's an EV play. Hold on. All right. And then let's go ahead and look using our other tools. Oh, first off, hold on. Let me say this. Let's go ahead and mark out those supply zones. Remember, supply zones this time because the trend is down, right? So I want to use supply zones as possible entries. So there's one. Motion in, halt, strong motion out. That broke below the previous swing low. All right, so we established trend here. Now this zone right here is actually like a trend making zone, we would call it, because it's right where before that the action was kind of going sideways, and then with that breakout from that zone, you reestablished or showed that it's downtrend, reestablishing the strong downside action. All right, there's one there. There's another one right below it, drop base drop, and then there's this whole sideways area right here. Now I tell guys not to be too squeamish if it's going sideways for a bunch of bars. That's a big pause right there. All right, so I got 3 areas that kind of look interesting to me. Let's see which one we should pick. See if we can get any more clues. All right, first thing I'm going to do is use the anchored VWAP. A VWAP. I'm going to anchor it from a high point. And actually, this is a call. That's actually the high point. But the piece I'm really interested in is this really sharp drop. So I may move that anchor over to right where, just where it starts to really drop. Where that impulsive move down is. Okay, and that lines up with one of my zones. So that's interesting. Next, I'm going to use the fixed volume profile. And that I'm going to anchor from, I'm going to do the same thing. I'm going to anchor from where it really starts to drop off. And then go all the way to the low point. All right, now that corresponds to this lower zoning area right here, which makes sense because it went sideways for quite a while. Okay, so we get a couple things going on here. And this is what being a trader is, right? You gotta make a call and see what you think here. No, this is a lot in the sideways stuff. It's going to be one of these 2 zones. I'm going to get rid of this zone above it. Now, one thing you always got to ask yourself, and this is maybe another tip. If your zone, and this is a common thing, especially with newer traders, they'll look for the furthest possible area they can use to enter a trade. Like they go a little too far out. And if you're trying to short something, or even go long, I mean, it goes both ways, that you don't want to get too far away because it comes back too far. And that's subjective, what far is, but you kind of know a little bit of experience. If it comes back too far to catch you for an entry, why? If I'm trying to short it, why is it that strong? Why did it come all the way back to there? Now, does it mean it couldn't work? It could work, but it's suspicious. Why is that happening? Why did it go that far? And then you don't want to get too on top of it either, because you take a chance of maybe getting, if you're really right on top of it, you're really just betting that it's going to just keep going and it's like a fast market. And that's a different scenario which you'd have to address. We'll have a video on that separately, how to deal with a fast market. If we're expecting a pullback, we kind of want to see it again halfway to that bottom half. Halfway is good. You don't want to see it go too far. All right. So with that said, in this case, our VWAP is corresponding with this like 142 area, and then we've got this larger sideways action right here. Which one do we use, right? My point of control is with the lower one, my VWAP's with the higher one. In this case, this is a case where I might, if I'm really bearish on this stock, I might make a play probably on the lower one first. And if that breaks or snaps through and catches up to this VWAP, I probably would have got stopped, right? That's one where I might take a second shot at it, at the VWAP, which would be the second zone right here. So I'm going to try this one first. If I get stopped out, which certainly can happen, I'm going to take a shot up if it rallies enough to catch the second level. And that's it for me. If it gets any stronger than that, I'm not going to mess with it. Again, there's that not bad zone a little higher. And I just don't do 3 shots at something. It's usually bad news, right? I have to limit myself to make sure that I only take 2 shots at it. So in this case, I'm going to go for the low one first, and then if it comes up enough to meet that VWAP, I'm suspicious it's going to come up to meet that VWAP, but I just see all this sideways action here with this big surging bar down, and I'm thinking, that might be enough to stop it on a rebound. Okay, so there's just some thought process there, right? This is how you make all these calls, and it's just using little pieces of evidence. You got to be in the right context. If this is going to be continue the downtrend, then what we're betting on is we get a weak move here or here, and then it comes down and resumes the downtrend. That's what you're betting on, right? That the stock is weak and will continue to be weak and keep bleeding. When do you know that you can't play that game anymore? When you break this area right here. Let me get rid of that. Which is the swing high, like this area. Once you're breaking that, we call that control swing high. Once you're breaking this control swing high up in this area, something's changed. The trend's not down. Don't try shorting it. Okay, so the idea is when we're shorting, we want to see the continuation, or going long, doesn't matter, the continuation of the trend movement. We're trying to take advantage of the counter trend action, just trying to figure out where that turn, in this case, something like that, where that turn is going to happen before the trend continues. Using zones, anchored volume profile, or anchored VWAP, and fixed volume profile in the right area, in the right context, the right spot is how you do it. Okay, hopefully that wasn't confusing. That's a lot to throw into a short video. If you have any questions, just ask me. I'll help you out. All right.